This is a little bit different of an episode because it's actually coming from two previous whiteboard explainer videos that I used to do while I was creating content on my website. I've decided for many reasons that YouTube is a better avenue to go, and as part of the blueprint one-page financial template that I'm putting together for people that I'll link down in the description, this is the beginning of one of those two videos, this one being on credit and building your credit. And before we get into it though, as always, we're going to get our Barron's Finance and Investment Handbook for our term of the day. Downtick. The sale of a security at a price below that of the preceding sale. If a stock has been trading at $15 a share, for instance, the next trade is a downtick if it is down 1/16 at $14.94, also known as minus tick. See also short sale rule. I'm Jerry McFarland. Welcome to Office Hours.
Welcome. Today we're going to talk about credit cards and how to start building your credit. We're also going to discuss tips for higher scores and how to leverage them to your advantage. You may be wondering, what exactly is credit? Maybe you've heard that term thrown around. Things like it's important to build credit. But what are you building exactly? What does that mean? Credit is a broad term, and it's used to denote the manner in which you return money to financial companies that have lent it to you. The statistical measure of this is the credit score, and it's the value of your ability to repay. Just like a grade or a number of stars. It will determine the cost, as measured by the interest rate, and the terms of any money you borrow. For example, let's take this house right here. Our situation, we've got a vacation property that costs around $700,000. We've got two people, person A, who has good credit, and person B, who has poor credit. Person A can get a 30-year fixed mortgage with 10% down at 5% interest. Person B can get a 30-year fixed mortgage with 30% down at 10% interest. The total cost for person A is $1.29 million, and their monthly payments are going to be $3,400. Person B, however, has a total cost of $1.76 million, even after the higher down payment, and a monthly payment of $4,300. Now, where does credit come from and go? Credit can be built in a multitude of ways, but it all involves your name being present on a commitment to pay an institution back. Examples of this: student loans, mortgages, auto and personal loans, and lastly, credit cards, which is going to be the focus of this. Credit also has an effect not only on borrowing money, but on the following as well: rental applications, employment opportunities, especially in business and finance, and insurance rates. Talking about credit cards, what I like to call the credit card monster, we have to understand that credit cards are the most accessible, efficient way for you to start building credit. They're also very dangerous if used incorrectly. It's like two sides of a coin, or a double-edged sword. We will focus on the correct setup and habits for their use. Now, credit is issued by large financial institutions and reported to the credit bureaus. Take, for example, a bank. You need money from the bank for some financial need of yours. The bank will extend you this money, but you're going to have to pay them back. And the bank wants to know how good you are at doing that. So they contract one of the big three: Experian, Equifax, or TransUnion. These companies create your credit report, which is delivered to you and to the banks, and has the most important number on it, the credit score, which is going to indicate how good you are at paying back money that has been lent to you. The things that make up the credit score are as follows. Payment history. Do you make your payments on time, regularly? Balances owed. Do you have huge mountains of debt? Length of credit. How many years have you been paying back? Credit types. Is it all credit cards or is it split? And new credit. Have you applied for a bunch of new loans in a short period of time? Now, these metrics are measured for each card, for credit cards, and for your debt as a whole. And the debt you will incur will come in two forms. Installment debt, which is like a mortgage or an auto loan that has a fixed payment until it's done. And revolving, which is a line of credit like a credit card you can draw from and pay back as you see fit over time. Now let's get set up. Setting up and the basics. You can apply directly for a credit card online or at your local bank. The provider will ask for a few pieces of information, like your social security number, your date of birth, your income, your expenses, your address, and they will ask for an authorization to pull credit. We spoke earlier about that credit report. They are basically asking to look at it to see how you stack up. If approved, you will be provided the card and made aware of the limit and interest rate. The limit is going to be the total amount at one time that you may charge or borrow on the card. And the interest rate is going to be the rate the institution will charge you on this money that you're borrowing yearly. Other items, missed payments and annual fees, intro APR, balance transfer rules and requirement, dispute rights, and billing and payment options. Now you're ready to start using your card. Here's how to do it correctly. Using your card responsibly. There's 3 levels to this. Level 1, that includes only spending money on the card you can afford to pay back immediately, and keeping your balances owed below 30% of your total limit on a rolling basis. So at any time during the month, if you go into your app and look, you are at 30% or less. And you focus your card spending on recurring, predictable monthly charges like your Netflix or your Spotify, so you know what it's going to be each month and pay it off automatically. Level 2, you instruct your other bills to auto pay by credit card and budget for their immediate payoff. You also pay all recurring monthly expenses like groceries, gas by card, and you pay off in full at the end of each month and or grace period. Level 3 is going to require some credit experience, but you'll conduct the entirety of your spending on credit card. No debit card. You'll use your credit card statement as a ledger of your spending habits. You'll periodically request higher limits so that your spending stays below the 30% threshold, but you will always pay it off in full before the end of the period. Here's a little cautionary illustration about bad credit card debt. Let's say you let a $1,000 credit card balance go unpaid past your grace date. Taking a look here, we're going to look at how it will grow in 1, 5, and 10 years. It will begin to grow the same way an investment does, except this 1,000 is debt, so it's going to be working against you. After 1 year at 25%, it will have grown to 1,250. After 5 years, 3,052. And after 10 years, $9,313. It's also going to work against you at a faster rate than your investments. The long-run average annual return of the United States stock market is roughly 10%. The average annual credit card APR is 25%. So let's look at another illustration here with that $1,000 credit card balance. So you have that balance at 25%. And you also have $2,000 in savings or income that you can put towards your balance, or you can put it towards an investment opportunity, let's say in an index fund, at 10%. In scenario A, you fully invest all of the money. And in scenario B, you pay off the credit card and do a partial investment. Scenario A, you invest $2,000 at 10% and it earns you $200. Your $1,000 credit card debt at 25% nets you minus $250. So your net change ends up being negative at negative $50. Now, scenario B, you pay off $1,000 debt as a sunk cost, and then you invest the remaining $1,000 at 10% for a plus $100 change. You can see that as a plus $100 change, or if you realize that the $1,000 was paid off as a sunk cost, it could be minus $900. But I want to go back and look at that $9,313 figure to show you why taking that net loss early is a good idea. So it's going to be a lot worse if we wait. Now, going back to our chart that looks at that 25% growing over those 10 years, it's going to have grown to $9,313, which once again is that $1,000 at 25%. The green line shows those $2,000 at 10%, the investment that we chose to take. So the difference between these two is going to end up being $4,116. So our net change is actually going to be minus $4,116 versus taking that initial $1,000 hit. So by waiting, we've essentially cost ourselves an extra $3,116. Now this is important to understand because there's some investing takeaways here. First off, always make sure your investment returns are greater than your debt's interest. And very few investment opportunities will return more than the APR of a standard credit card. And in 99% of cases, you will be better off just eliminating the high interest debt. Now, here's some more on credit scores. The most commonly used credit score available to you and lenders is the FICO score. FICO stands for Fair Isaac Corporation, which is publicly traded under the ticker FICO, and has been around since 1956. The more you know. Now this is what makes up the FICO score. Amounts owed, new credit, length of credit, credit history, and payment history. For new credit, large amounts of credit applied for in a short period of time will not look good. Waiting at least 90 days between credit applications will aid your score. Accounts open for multiple years is going to look good. Closing accounts frequently is not going to help. And installment debt is also going to help because it's paid off over many years. Your credit mix, you want to have a mix of different credit types: mortgage, auto, education, credit card. You don't want to be concentrated in any one type of credit, which is what it's saying here. A lot of credit card debt doesn't look good to a lender. You also don't want to have high credit use to credit limits, known as revolving utilization. It's that 30% number we talked about earlier. We want the revolving utilization to be below 30%, so on a $1,000 limit, $300. We also don't want really high loan balances or maxed out cards. Lastly, we don't want to miss payments. We want to make the payments on time, regularly as they're billed. If bills aren't paid, they can be sent to collections, which is even worse. And making at least the minimum payments is always good. Furthermore, if you miss a payment, you want to pay it off right away, even if you missed it, and not let it go, 30 or 60 or 90 days out, because that'll ding your score further. Here's some tips and tricks. First off, get your credit cards from institutions solely focused on credit or from reputable banks. Places like American Express or Discover are great, and Chase has some really great credit cards. Also, avoid cards with annual fees. If your cards do have fees, get them waived. You can always call and say you're thinking about canceling, and they will most likely waive it for you. When you get a raise, call your credit provider and ask for an equivalent raise in your credit limits. And missing one payment with one lender can evoke what's called the universal default clause. Those lenders talk to each other, and if you miss a payment on one credit card, all your other credit cards will be made aware, and by law, they're able to up your rates. Have 2 to 3 open credit cards at a time so your total revolving ratios look better. That's the sweet spot. And order extra cards for loved ones who could benefit from sharing the credit histories. Open cards with lucrative introductory rewards for large purchases. Maybe a car, a new laptop, washer and dryer, or TV. Oftentimes the providers of these items will have cards. Also use your high credit score as a resume item, proving organization and management skill. Pick 2 days a year on memorable occasions, like the 4th and New Year's Eve, to check and read your credit report. And remember to be a transactor, not a revolver. Those are the names that the credit companies apply to you, and a transactor is somebody who pays off their balance in full every month and doesn't revolve over to other months.